This is not going to be one of those videos where I try to convince you that the real estate market is going to implode. There are, a couple thousand talking heads out on YouTube that will tell you that. I'm not one of them. But I do want to talk to you about what's going on with interest rates and how that's going to affect real estate, buyers, and sellers. Let's get started. Welcome to our YouTube channel. I'm Mike Lavoie. My wife Paula and I are realtors here in the beautiful Tampa Bay area, Florida. Well, unless you've had your head buried in the sand for the last, year, I'm sure you've seen mortgage rates are going up. And they've gone up a lot. Rates have gone from the lows around 3% to just over 6%. I think it's 6.42 the last time I looked. This chart from Freddie Mac is going to give you some kind of idea just what happened. We started the year around 3%. In March, the Fed bumped the Fed Fund benchmark by 25 basis points, and that was the first increase in the benchmark in 5 years. Mortgage rates ended the month a little bit higher at 4.67%. In an effort to control inflation, the Fed made several more increases over the year, which caused mortgage rates to climb. In fact, they didn't climb, they jumped. We hit the high for the year in November at 7.08%. To put that into perspective, when I purchased my first home, the year was 1982. It was a U.S. home-built home located just off of FM 249 in a suburb northwest of Houston. Actually, back then it was called FM 149. I'm not sure why they made the change. But I was ecstatic to get the low rate of 16%. And I really had thought we had hit pay dirt getting that 16%, because a couple of months before that, the 30-year mortgage was well over 18%. The last time we've seen rates close to 7% was 2002. Before that, 7% would have been considered pretty normal, if not pretty good. The issue is we've gotten very accustomed to mortgage rates in the 3 to 4% range. And unless you deal with it, every day, most people have forgotten those higher rates. A good number of people have never experienced those type of rates. When you think about it, higher mortgage rates affect first-time home buyers the most. The average age for a first-time home buyer is 36. That means today's first-time home buyers were 12 or maybe 16 years old the last time the rates were over 3%. I don't think many 12-year-olds were concerned about mortgage rates. So all that's really nice, but it doesn't make my buyers feel any better about a 7% mortgage. The compounding issue we've had was demand, especially over the onset of COVID. If you take a look at the last 5 years, from January 2017 through January 2020, prices rose annually 4, 5, 6%, hovering around that 4% that's been normal since the beginning of time. COVID was discovered in March of 2020. Bam! Annual increase in home values went to 10, 15, 18, 30%. In Florida, annual increases were close to 25 and 30% per year. People were pulling up stakes in the Northeast, Midwest by the hundreds, and were heading to Florida. A good majority of those were paying cash for the new home in Florida. Buyers were doing things that a year earlier would be pretty much unthinkable. They were waiving inspections, guaranteeing appraisals, making offers sight unseen, having leasebacks, offering their pets as part of the deal. All that demand created a crazy market where one home would get 20 offers on the first day it was listed. Sellers were able to pick and choose the best offer, usually based on price. That demand caused a huge increase in prices over a 2-year period. The net effect is that new buyers now are paying the price on both ends. They're purchasing a home that has been run up in price dramatically over the last couple of years, and they're paying a higher interest rate. It's no wonder the housing market is starting to slow down. Sales in my MLS are down close to 25% year over year. Quite honestly, that's a good thing. The growth we had in prices, it just was not sustainable. Demand was far outpacing supply. If the Fed had not done something, the market itself, I believe, would have corrected on its own. Inventory was so low that there was very little that was for sale that somebody really wanted. And buyers were getting frustrated with the whole bidding process. A lot of those buyers, a good number, were already starting to back away from the whole buying process to sit on the sidelines to wait and see what happens. A lot of people that I run into are questioning the time to buy. Most are waiting for rates to come down, or maybe the prices of the house to drop enough to make up the difference of what they're paying for rates compared to what they could have paid for rates. Once upon a time, in a far, far away place, I was a financial planner. So I pulled out my trusty dusty HP 12C financial calculator and did some ciphering. Their questions were twofold. How much money are they going to have to pay for a home at 7% compared to, if they could have got it, 3%? That's pretty simple. By the way, I'm working on principal and interest here. There's no HOA or taxes included. At 3% with a 30-year mortgage, 20% down on a $500,000 home, that calcs out to a $1,686 monthly payment, principal and interest. That same purchase, $500,000 at 7%, works out to $2,661 on monthly principal and interest. Just under $1,000 a month difference for that same house. No, it's not really fair when the neighbor next door was able to lock in 3%, 10, 11 months ago. The second question, how much would the price of the home have to drop to make that payment come close to the $1,600 payment? That's not as easy a calculation, but if you work the numbers backwards, the price of that $500,000 house would have to come down 37%. 37%, you're talking about, cataclysmic events. Something along the lines of the Great Recession, 2007 and 2011. And then prices only dropped, it was 21%. Could it happen? Sure, anything is possible. Pigs could fly. Are there some cities having issues? No doubt. According to Case-Shiller, Seattle is down about 8.2% from their peak. San Francisco is off 10% from their high. Here in Tampa, prices are down 1.4% from our peak. Will prices continue to come down? Yeah, more than likely they're gonna. Buyer demand has slowed slightly, particularly in the first-time home buyer market. Lack of funds for a decent down payment, interest rates, and increasing home prices are still creating an issue for those who are trying to buy for the first time. Yes, you heard correctly, increasing home prices. Sales may be down. Prices are 1.4% off their peak, but prices are still 11% higher than they were this time last year. Demand is slow in the first-time home buyer market, no doubt about it, but we still have a huge influx of people leaving the West Coast, Midwest, and Northeast parts of the country. They're all moving to Florida and have to live somewhere. Most are selling a home wherever and buying one here. People here, unless they have some life event like divorce or death, them to transfer out of the country, out of the area, are not selling their homes. And why would they? Take us, for instance. We could sell our home and clear a tidy little gain and move into a smaller home. At 7% interest? I'm at 2.9 now. Why would I want to move to another home that costs pretty much the same as the one I'm selling, of the current home I'm selling, and have a 7% mortgage? That is keeping inventory tight. Yeah, there are news organizations out there, mostly talking heads on YouTube, saying that inventory is up 150%. That is very true. 6 months ago, we had like 2 weeks of inventory. Right now, the Tampa area has close to 3 months of inventory. That is a huge percentage increase, but it's not even close to what is considered a balanced market of 6 months. However, that increase is great for my buyers. They actually have choices. We can negotiate now rather than just trying to outbid the other buyers or buyers. The rush to get an offer in before it's gone is gone. It feels more normal. On the downside, they're paying more per month than the guy next door who bought a house at 3% a year ago. Not fair, especially for the first-time home buyer, but that's the way it is, and we're probably going to have to live with it for quite a while. With this change in market, Lenders are getting more creative with interest rate buydowns. First-time home buyer programs are coming back. All of those loan programs are not necessarily permanent. If rates do come back down, and I wouldn't look for the 3% again, but if it came down, you can always refinance. I mean, homeowners have been doing that for decades when rates move lower. New home builders are offering massive incentives again. The reality is, higher rates are here to stay for probably quite a long time. If you're going to need to live somewhere, you can either pay your mortgage or pay your landlord's mortgage. I understand the hesitancy of buying right now. If you want to talk about it, give me a call. I'd love to hear your thoughts. Thanks for watching, and if you're not a subscriber, click that button down below. Have a great day.